Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it feels good to be back. Wasn't that long? Well, I guess it was, actually. Didn't feel that long. No vacation ever does. But it might be a new year, but nothing's really changed. I mean, we're going to get into what's changed a lot this year, or potentially. But, I mean, like, the markets are kind of reacting the same way. So, new year, same bond market, and equity markets as well. But welcome, everyone, to Wilmington Mortgage. It is the Monday edition of Wilmington Mortgage, and I, of course, am the aforementioned host of this podcast, Tyler Cralle, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina. And what we do on this podcast is try and break down, which direction rates are moving, which you can kind of figure out by looking at the 10-year and other market indexes. But then why? Why are they doing that? We're going to try and do it, and we do it in 15 minutes or less. So there you go. And it's not really a big question this morning because there is one huge story that is sucking up all the oxygen for obvious reasons. And this is the sort of big change that is happening in 2026. And that would be Venezuela. So for those who have been, I don't know how you could have not seen this story, but over the weekend, just as the new year, we were kind of beginning the new year. I think it was on the 3rd, or was it the 2nd? Was it? No, it was the morning of the 3rd is when this happened, I believe. The United States went into Venezuela, Caracas, where Nicolas Maduro, the so-called president, was. Of course, we all know he lost the last election and was just sort of seizing power in Venezuela. They go in, pull him out, and bring him back to the U.S., and they are going to indict him. They are going to put him on trial, and that's exactly what happened today. He was in a federal courthouse pleading not guilty to U.S. charges, claiming that he was a prisoner of war. And while it looks like his fate is sealed, the fate of the bond market, however, is not. And while it does seem like maybe we know what's going to happen, we really don't. We really don't, because there's a lot going on. So it's not only the U.S., I mean, it's not only Venezuela, but there's also, we got riots that are happening in Iran. We've got talk about Cuba and the United States somehow getting involved in Cuba, maybe getting involved in, I think, Colombia. There's also, of course, just unrest sort of happening in the world, and sort of what happens if the U.S. gets involved in one conflict. Does that mean, for example, China could then move on Taiwan because the U.S. is preoccupied, and there's just a lot going on. We don't know what's going to be happening going forward. Now, normally the playbook when it comes to unrest, global unrest, especially when you don't know how exactly things are going to end. So it's not like we know, okay, we went in there, took Maduro. We know who the next president's going to be. I mean, we all have an idea, but we don't know. And then, of course, the compounded effect of what's going to be happening in these other countries. So normally when that happens, investors are like, whoa, I don't want to have my money in any particular aspect of the economy that could be impacted by a war that could go on for we don't know how long. There could be, we could have a war, we could not have a war, so that all of a sudden defense contractors could see their stock prices rise. But maybe nothing does happen. So do you want to move your money out of one, company, put it in defense contractor? People are talking about oil prices. Do you want to have your money in oil futures? Things like that. People don't know. They're not certain where they want to have their money. So what you do is you go to bonds. That's the safe investment. That's the safe haven. And so normally global instability, flight to bonds, that then, of course, pushes the prices up, which, of course, pushes yields down. So we should see bond yields fall, which is exactly what we saw today. The 10-year was down about 4 basis points as of the close or heading into the close. So we're looking at about a 4 basis point drop. That would be the first drop that we have seen all year. So that's awesome. However, we have seen kind of a slight increase. However, mortgage rates, if you're looking at Mortgage News Daily's 30-year fixed index, they have the 30-year fixed at 6.19%. That is actually down 1 basis point from Friday's close and is the lowest level that we have seen since October. Now, of course, that's what Mortgage News Daily is saying, and then we have a drop in the 10-year. So by all accounts, bond yields are down. So, okay, the idea, the sort of normal playbook that you would expect to see is happening. However, in this case, there's some other risks that are involved. Paul Donovan, UBS chief economist, flagged this morning in a note the fiscal angle. So we all know that, of course, the United States is adding debt by a record amount, even once we shut off COVID spending. Domestic spending is just crazy levels and looking to rise as baby boomers retire. Social Security costs, Medicare costs. And Donovan noted that military adventures cost money. That might be the most significant consequence of the weekend's activity. So we're already spending a ton of money. And what was the deficit? I mean, I think we ended up at the end of the year almost exactly where we were the year before, $2 trillion deficit. So we're adding $2 trillion to the national debt every year. And like I said, this is without a major foreign conflict. This is a lot of it is, of course, entitlement spending here in the United States, the growing Social Security, Medicare expenses that are only going to increase as, like I said, baby boomers continue to retire. And so to add a potential cost, a military conflict, you could see a potential where, all of a sudden people are going, this debt load for America is getting to a point where we are now getting concerned. And so could you see investors say, maybe we're not going to invest in treasuries. We're going to pull out of treasuries. So that's one of the concerns. Now that's, like I said, going to happen further down the road if it does look like there is going to be more of a U.S. involvement, a U.S. cost, then you could see that change. But short term, no doubt, lower yields with regard to the bonds. Desmond Lockman, who is a senior fellow at the American Enterprise Institute, also warned, he told Fortune magazine, that the episode could amplify concerns about U.S. reliability. So if foreign governments worry assets can be frozen or politicized, central banks may rethink how much of their reserves sit in dollars or treasuries. And I think it's about, I can't remember. I had the number in front of me like a little while ago, and I got rid of it for some weird reason. I think it's 9%. I'm sorry, 25%, $9 trillion. That's what I was looking at. $9 trillion in U.S. treasuries, 25% of total U.S. debt is held by foreign investors, governments, all of that. And so if some of those investors start questioning, do we want to have our money in the U.S. just out of this concern? Could it be frozen? Could it be an issue getting a hold of it? Could you see them start liquidating their positions? And that, of course, would then cause treasury yields to rise. So, I mean, the way I'm looking at this, no doubt short term, what we are seeing is yields falling. That will be good for mortgage rates. No doubt about it. The question is what happens going forward? Do we see things kind of stabilize like after what happened over the summer with Iran, where there was some concern about what the global impact would be, and then of course there was none. And so could this all just sort of be a lot of hype and then kind of nothing happens, everything kind of stabilizes, and so we would get the benefit of kind of that, maybe drop in yields and then maybe just kind of staying at that lower level, or do people worry about what the U.S. involvement could look like going forward? What sort of cost would that be for the U.S.? And so that's the bigger question. So short term, definitely a benefit. Long term, if there is a long term, you could start to see, like I said, foreign investors maybe question their money being in the U.S. And then, of course, an added cost. When does our debt hit a level where investors start to get concerned. So short-term good, long-term bad. Make it simple. We didn't get a lot of data for the day other than what was happening with, of course, Nicolas Maduro in New York. But we did get a manufacturing report for December. This was the latest ISM manufacturing PMI from the Institute for Supply Management, showing that economic activity slowed in the final month of 2025 to an index of 47.9. That was down just a little bit from November and was the weakest reading that we have seen since October. Economists were expecting a smaller dip to 48, so not a huge difference. They were expecting that drop, but a little bit worse than they were expecting. This is now 10 straight months. Manufacturing is in contraction territory under 50 and has remained below that 50 break-even level since early 2025. New orders rose slightly, so there's some good news there, to 47.7, but that's still the second lowest level in the last 5 months. Employment, also some good news, ticked up to 44.9, yet that remains the second weakest reading in the last 4 months. And then prices, also kind of good news, held at 58.5. That's the second lowest level in the last 11 months. So the concern about prices, no doubt tariffs being the main factor there. That was actually reading the reports. They have like sort of different categories of manufacturing, and 6 of the 10 mentioned tariffs and the impact that had on manufacturing in 2025. And so there was no doubt that manufacturing was having a rough go of it in 2025. A lot of it because of the input prices, tariffs impacting their inputs to the products they're using to manufacture here in the United States. And it's still being felt. There's no doubt about that. So it's kind of a rough year for manufacturing in 2025. Tariffs will still be an issue. And then, of course, the concern, as we just mentioned, with everything that's happening globally, could things get worse? What could conflicts do to supply chains, things of that nature? So no doubt that manufacturing is struggling a little bit in the U.S. Like I said, 10 straight months in contraction territory. Some silver linings, as we mentioned, Suzanne Spence, chair of ISM, noted that although the demand indicators are still in contraction, improvement in 3 indexes, which would be new orders, backlog of orders, and new export orders, as well as the customers' inventories index remaining in too low territory, did show positive signs for December. So we are seeing some optimism, but the lingering impacts of tariffs, as well as, this report obviously came out before what happened in Venezuela, global uncertainty could be another factor for manufacturing. But remember, when manufacturing and the economy are showing signs of weakening, that could be that's good news for rates. So always sort of keep that in mind. So not a great report, a little bit of optimism, but not a great report for manufacturing, but some positive signs, and that this could be good news for rates. Now, of course, what's happening with Venezuela and some of these other global possible conflicts, concerns are definitely going to weigh heavier than a slight movement in manufacturing, but still something to keep an eye on. Still something to keep an eye on. All right, on Tuesday, nothing's happening. No major reports, so we'll keep an eye on kind of what's happening with the news, and so we don't know what could potentially be moving rates tomorrow. But it is jobs week, our first kind of real big official jobs week since the shutdown. We're getting all the reports timed perfectly the way it's supposed to be. We'll also get some information on housing. So a busy week going forward, despite tomorrow being pretty quiet. We are looking at a pretty busy week on Wednesday, Thursday, and Friday. But you guys enjoy the rest of your Monday. We'll be back here Tuesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.